Calling to order the Lake County Investment Advisory Committee this 17th day of April 2025 at 9:45 a.m. We'll begin with a call to order. Mr. Zurn, would you call us to order?
Yes. The roll call is Commissioner President Pleshnik,
Present.
Vice President Beveridge,
Here.
and Treasurer Mike Zurn. I am here.
Very good. So we have unanimous and full attendance. Next on the agenda is approval of the minutes for the meeting of January 9th, 2025. Do I have a motion to approve, waiving reading of the same?
Move to approve.
Second.
All in favor?
Aye.
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 It is unanimous. The minutes are approved. Any old business to come before the Investment Advisory Committee? Any old business? Hearing none, we move on to new business with our investment review. Ms. Stanek.
Good morning, and thank you very much. Really appreciate the opportunity. Before we hop into the presentation, I did want to give a little update real quick here on Meter. Since we have submitted our updated regulatory filing with the Securities and Exchange Commission, which we are required to do on an annual basis, we have updated asset numbers and clients, and I'm happy to report that we now serve 429 public entities throughout the nation. A high percentage of those are Ohio public entities, and our assets under management with just public entities now totals $59 billion. So we are one of the largest investment advisors to public entities throughout the country. Continue to hold that that accolade. Getting into our what's happening here in the market, I think we can start out by saying one key point here during this environment: the certainty of uncertainty has increased. There's a tremendous amount of uncertainty in the marketplace as a result of the recent tariff announcements, and needless to say, we are following that very closely. We did issue a white paper kind of as it related to with an update on tariffs very shortly after President Trump had made the announcement. And additionally, we did hold a webinar yesterday where we addressed some of the what we're seeing in the marketplace, as well as our the risks associated with the tariff discussions and the like, and the Fed. So clearly, though, this reflects now, what our outlook is, what we're seeing here. We know that the Fed is sticking to their story of potentially 2 rate cuts in 2025. They're being very cautious, very patient in providing really any guidance beyond that, other than to say that because of the uncertainty of the economic and market impact of the tariffs, that they really need to see the data. They need to see the impact of the new administration's policies here in the data before really moving forward. So that being said, the expectations are that rate cuts will not start till the latter part of this year, maybe as early as June or July. Inflation, of course, has remained relatively a little sticky, to say the least, and the Fed has been very focused on their fight against inflation, in spite of the fact that expectations now for growth have dropped pretty significantly. We've heard a lot of folks on the street talk about increased probability of recession, but no one is calling it yet as far as saying, a specific time period. The employment numbers have remained relatively strong. That's the other side of the dual mandate of the Fed. And of course, interest rates have been all over the board. We were talking earlier about the volatility in the marketplace, and not only with the yields from, say, when the bond market opens in the morning to the close, but also what happens in the middle of the day. And there have been days where we've seen interest rates, say in a 2-year Treasury, move within the day by about 50, 60 basis points. So a tremendous amount of volatility, a tremendous amount of uncertainty. This graph here is showing really the market's expectations for those cuts in interest rates in 2025. The market's a little ahead of the Fed in that the market is expecting that we could have anywhere from 3 to 4 to 5 rate cuts in 25. That would bring that overnight rate down to around 3.5%. Again, the volatility results in these numbers, these probabilities changing every day. When I checked it just this morning before I came, the market was more in line with maybe 2 to 3 cuts. So again, there is this tremendous amount of uncertainty. Inflation, the mandate for the Fed to maintain stable prices. We've seen the CPI rate come down. We're now at 2.4%, pretty much in line with the core PCE measure, which is just a variation of an inflation statistic. That's at 2.6% last read. Fed still has their 2% target, so clearly they have a way to go. But I think one of the keys when we think about inflation is really what are the expectations for inflation. So this data is historical. This is the data that the Fed is looking for. They're looking for historical data, but the market looks for expectations. And the New York Fed does a survey of consumer expectations for inflation. And the one-year expectation for inflation from consumers has increased from 3.13% to 3.58%. So the consumer is expecting inflation to be a little more sticky and maybe to increase a bit. But when we look at the longer-term view, the 3-year view of consumer expectations, and one could argue it's very hard to know what's going to happen next week, let alone 3 years. But that expectation from the consumer's perspective is that inflation would settle down at around 3%, which is also, of course, higher than the Fed's target. But be that as it may, these are statistics that, the market is also looking at, and that's how they are then pricing in the expectation for, Fed rate cuts or slower growth or potential changes to the employment situation. Growth, as we had mentioned, expectations are for growth to slow. We're now looking at the expectations for 2025 economic growth from the Bloomberg survey of economists, and this represents about over 50 economists from the academic world as well as Wall Street and the like. So it's a broad range of economists, but the average is that we're looking at economic growth for 25, starting out with a 1 versus, that the numbers that we have seen of late, coming out of after all the stimulus dollars that were put in the economy of, that 2 plus to 3 to 4% growth rate. Again, today, one term that is being raised a little louder is the risk of stagflation. So we know stagflation is a condition where we have higher inflation, which, as we see the tea leaves today, looks like that may be the case, but we have slower growth. And as we're seeing here, the expectations are slower growth. And additionally, in a stagflationary economy, we also have increases in the unemployment rate. So a little different than a recession, but a condition where we do have growth, but it becomes very painful for the consumer and for businesses particularly. And we always want to keep in mind that the consumer represents 2/3 of the U.S. economy. So that's where employment is very important. From the consumer standpoint, we look at the top graph here. This is the unemployment rate. Currently stands at 4.2%. When we think of what is generally the I would say accepted range of full employment, that would be 4.5% to 5.5%. So clearly the U.S. economy from the unemployment statistic is still operating with a very strong labor market. And we're also seeing this by looking at the bottom chart, which is the number of months that the unemployment rate has been below that 4.5%. 41-month streak. So we're rivaling the time period from the 60s. And actually, if we didn't have probably COVID, in between the 2016 and 2023, it's very possible that we would have surpassed that. Just kind of on another note on the job situation, job growth has slowed a little bit. We look at the 3-month average job growth, it's around 152,000 for the first quarter of 2025. We compare that to the 2024 average, which was closer to 170. Interest rates. 2-year Treasury and the 5-year Treasury, looking at these levels on a historical basis. As we can see, that volatility there where rates have, increased very significantly and then do drop here over the past year plus. But when we look at the overall level of rates, these rates are still what we would characterize as attractive. These are rates we haven't seen still for well over 15 plus years. So when opportunities do present themselves and when we can, we think it's prudent to continue to at least lock in these rates at that 4% on average level, just to protect that interest income for the county for a longer period of time. So the county's investment portfolio here. So we're looking at the cash piece, that's monies that's invested in overnight accounts, and then the securities piece of $282 million, $426 million of what we characterize as operating funds. We've peeled out the piece related to the engineering utility funds as well as the safety center, which is separate. So the operating piece has a weighted average yield of 3.65%. That's up from where it was in the previous quarter. And when we look at the maturity distribution, we can see that we do have a significant amount of dollars maturing in that 0 to 1 year. That has been purposeful to take advantage of some shorter term rates, which are very high relative to term rates since the Fed is on hold, as well as positioning the county's investments so that funds will be available to fund any costs that are needed to be funded from this portfolio for the safety, center. I always want to say safety service center, it's safety center. But as we can see here, the securities that we do have locked in longer term, those definitely are yields that we are fall into that range that we consider attractive.
And Mrs. Stanek, I want to thank you for your expertise and your market insight, and
Thank you.
just to acknowledge all your help on a weekly basis, looking at the maturing securities and the best option and where we could put these securities and the length of time that we could reinvest these securities for the maximum return. But we also, not only do we look at the maturing securities and the best place we could place them, whether it's commercial paper or CDs or treasuries, but we also look at what the county needs for operating the county and also the project. So the breakdown of funds is really tailored to what the county needs, and we really look at every single dollar and where we could put an investment longer term for a greater yield or greater overall return. So we've really maximized the dollars and investments, and I really want to thank you for your weekly our weekly meetings to break down what is maturing and what we need to operate. I think it's really maximized our return on our portfolio.
Well, thank you. And I will say the collaboration definitely is a testament to the openness and knowledge of Treasurer Zurn here, and we greatly appreciate it as well.
So any questions for Ms. Stanek? Any questions? Hearing none, we are ready for a motion to adjourn.
Move to adjourn.
All in favor?